The business entity type determines its tax treatment. There are several types of business entities and different respective tax treatments. A sole proprietorship is a business that is owned by one person and that is not incorporated. Tax treatment for self-employed persons or independent contractors is similar to that for sole proprietors. For tax purposes, the income and expenses of the business are reported on the owner's income tax return, and the owner also pays self-employment tax. The owner may also be responsible for excise tax, estimated tax, and for employment taxes. A partnership is a business that's owned by two or more persons or entities that share in the partnership's profits and losses. The partners are not employees of the business, but rather are considered as self-employed. For tax purposes, the partnership must file an informational return that reports operational profits and losses, and the partnership is responsible for employees, employment taxes, and any excise taxes. The income tax that the partnership generates passes through to the individual partner's tax return based on each partner's share of the business. The individual partner is responsible for income tax, self-employment tax, and estimated tax. A corporation is an entity that's formed by adhering to certain formalities, including the filing of articles of incorporation with the state, creating bylaws, exchanging capital stock for shareholder money or property, creating a board of directors, and holding a meeting for the board of directors at least once a year. For tax purposes, the corporation makes deductions similar to those for a sole proprietorship, but has a double taxation aspect in that the profit is taxed both to the corporation when it's incurred and also to the shareholders when it's distributed as dividends. Shareholders may not deduct corporate losses. An S corporation is a small corporation whose shareholders avoid the double taxation aspect of a regular corporation. The shareholders would be responsible for the federal income tax due for certain capital gains and other passive income. A limited liability company is an entity that's formed under the requirements of the state law by filing articles of organization with the Secretary of State. It has attributes of both a corporation and a partnership, and its owners are referred to as members. For tax purposes, by default, if an LLC only has one member, then it's treated like a sole proprietorship. If it has more than one member, then the tax treatment defaults to that of a partnership. In both instances, an election may be made to treat the LLC like a corporation. Employers are responsible for making deductions for Social Security taxes, medical taxes, and federal unemployment tax. Social Security and Medicare taxes apply to all wages for work conducted by employees in America, and in some instances, for work performed outside of America. The taxes are deducted from the employee's pay and used to provide retirement and medical benefits under the United States Social Security system. If self-employed, the self-employment tax likely meets the Social Security and Medicare tax requirement. Federal unemployment tax funds a federal and state program that provides unemployment pay to workers who are unemployed due to lost jobs. FUTA is the employer's responsibility and is not deducted from an employee's pay. Excise taxes are taxes imposed by governments for a number of miscellaneous areas, such as fuel or gasoline tax, environmental tax, licensing tax, or communications such as telephone service tax. Deductions reduce the amount of an entity's income that's subject to tax. In business, a deduction may generally be taken for ordinary expenses that are incurred or paid in the taxable year and are necessary for conducting a trade of business. The rules for business deductions are complex and they change frequently. Some common deductions include employee pay, capital expenses, depreciation, and business bad debts. Corporations that have $10 million in assets and file a minimum of 250 federal tax returns, including income, excise, and employment tax returns, per year, must file these returns electronically. The filing system used is called modernized e-file. Under specific limited circumstances, the IRS may grant a particular corporation unable to e-file with a waiver.